Welcome back to EDS, and in this video we are going to take a look at how you can write your own options contracts, collect a premium upfront, and generate consistent returns year on year. Okay, so first thing we want to do is find out where we are in the options chain. So we just want to pull up something like Apple. Okay, we're in our brokerage platform Tasty Trade right now. So this is the options chain, right? We've got two types of expirations. The type of expiration with an orange W and then everything else. The orange W is a weekly. For as far as we're going to be going out, the weeklies don't really make sense for us. There's not too much going on there. So the monthlies is what we're going to be looking at. So we're not going to go with the September 20th. It's only 9 days away. So we're going to go with October 18th. We want to be somewhere between about 30 and 60 days out in time. This is 37, so that will do. So October 18th, right? So now we know our contract length is going to be 37 days out. What we want to do is make sure that nothing disturbs us for the next 37 days. So over here, what you can do is filter out everything that has earnings over the next 37 days. And what earnings will do is it will increase volatility. You can mess up your deltas. So we want to avoid earnings, right? So everything here does not have earnings in over the next 39 days. So now what we need to do is, so this is just any watch list, right? You can make your own watch list. It doesn't really matter, just as long as there's lots of things on there that you can potentially trade. Next thing we want to do is sort everything from high to low IVR. You want high IVR at the top and then low IVR at the bottom. As we can see at the bottom here, we've got 13.6 and at the top we've got 99. The reason for this is we like to sell volatility, so we need to sell it when it's high and then play the contraction. So we just go down the list. We've got United States Steel. We did a video on this recently, so we're not gonna go over US Steel again. The Australian dollar futures. We aren't going to discuss futures today, but it is pretty similar. Kronos Group. You also want to be taking a look at, the liquidity, right? The liquidity indicator. You want to make sure everything's a 4 or 5 star. You also want to make sure you want to be paying attention to the price of the actual underlying. So, for example, Intel's at $18.94. BA is at $158. The reason why this is important is it's one of the things that will determine the amount of buying power that's required if you have a naked position on. And ideally, we do want to be placing naked positions. So, for example, you've got BA with 150, that's at $158. GDX, that's trading at $36. So let's take a look at GDX. We'll go over to the trade tab, October 18th, 37 days away. And now we are in the options chain. This orange bar here shows you the expected move of the underlying over the next 37 days. So of course we want to be outside of this expected move because we're going to be selling options contracts or writing the contracts. So typically speaking, you want to be 16 to 20 deltas out. And before that, you do want to obviously have a look at the spread. It is 10, 15 cents wide. It's not the best. Market has just opened. Hopefully, we can get a bit of a tighter spread in a couple of hours' time. But for right now, for the sake of this example, if we go with a 16 delta call and then we go with a 16 delta put, as you can see here, we'd collect $58 upfront in premium. We are outside of our expected move, and it would require $367 in buying power. So a very small amount of buying power required, and would collect a nice $58. We've got a 75% probability of profit with this trade, so a very high probability trade. We are almost delta neutral. We're as close to delta neutral as we can be, pretty much on this trade. And yeah, this is a perfect position. This looks like a position that's ready to go. If we were to map it out on a chart, and let's see what it looks like. So we've got our strikes at 33 and 41 on GDX. So 33 41. There we go. That would be the range. So as long as price stays within these two lines over the next 37 days, and expiration is between these two lines, which we know we've got a 75% chance of happening, then we will keep all of the premium that we collect, all of the 58 cents, and we will keep all of that. And it will be added to our cash balance. So GDX, this is a very nice range. As you can see, we're right in the middle. So with that being said, that's GDX. This is called a strangle. Is a short put and a short call. Is a naked position, and that is how you find new positions. If this number here, the buying power requirement, was too large for you, you could always just buy another contract further out. So you could buy a contract the next strike down on the call side, and then buy a contract the next strike down on the put side, and this will reduce the amount of buying power required. It will reduce your premium that you collect, but it will reduce the buying power. Of course, you can expand your the width of your strikes, collect more premium, require more buying power. You get the point. You can play with it and make it fit in your portfolio. So now, speaking of portfolios, we're just going to take a look at our portfolio. This is one of our portfolios. It is a small portfolio. However, we've been doing quite well with it. So what we're going to do is we're just going to take a look at what we did yesterday. So yesterday we made an adjustment. Yesterday on CMG we actually closed the position in a nice bit of profit. So as we can see here, we opened the original strangle for $1.08. We bought it back for 79 cents. We netted a total of $29. It might not sound like much, but it was a profit of 26.8% on the overall position. That translated over to a nice return on the portfolio itself. So if you guys want to get involved on this kind of stuff, links will be in the description. There is one other thing that you need to be aware of. It is this position sizing template. You want to make sure that no matter what positions you are putting on, your sizing is correct. Otherwise, everything else doesn't matter and you will blow up your account. So the way that this works is you just enter in the size of your portfolio. Let's say if it's $4,000, then you enter in the current VIX level. Let's say it's at 13.2. Everything below will be automatically calculated for you. All you need to do at this point is use this to structure your portfolio, use it as a backbone of your portfolio, and you'll be fine over the long term. So click the link in the description and it will take you to this page. All you got to do is click free position sizing template, enter in your details, and we'll send over your template free of charge. Also, if you do want to get involved on our positions and see what we're doing, again, click the link in the description and click on EDS Premium. This will allow you to sign up to EDS Premium, and inside you will get access to all of our portfolios. So no matter what size portfolio you have, there's positions there for you to copy and follow. We have a full course, so you don't need to know anything before joining. We will teach you everything you need to know. It allows you to earn and learn at the same time. It is a Discord group, so you can speak with myself and other like-minded individuals. We've got a 100% money back guarantee, so you can study our full course and follow our trades for 6 months. If you haven't been profitable or seen results, then we'll work with you for free until you do, or you can request a full refund. So it's completely risk-free on your part. Right now it's £1 a month. The price will be rising, but whatever price you pay, you are locked in at that price. So you are rewarded for getting in early. With that being said, I'll see you guys on the inside.